In the last session, we just discussed with regard to an long term, short term and medium term sources of financing, and now we shall continue with the concept of what does a share means, what does a debenture or a debt means, and long term venture capital and hybrid financing. So, this core concept is very much important because these are the basics to carry out to treat what does a cost of capital, because we just explain about the opportunity cost of capital where how we treat in payment of a dividend on payment of an interest. The overall concept relies upon debt and equity. Due to that, it is very much necessary for us to know what does a shares, debenture and term, different types of investor, hybrid financing, all these things. The first concept under here is shares. As I mentioned earlier, equity share. What does a share means all about? We always said equity share, that the shares which has been issued by a company and which has been issued primarily from a new issue market is called as a primary market, and it is for as the name itself is mentioned, it is new issue of a market is nothing but a fresh issue of a share. When we talk about rights issue of a share, already existing shareholders will be there, and issuing of a shares to the existing holders only for an existing shareholders would be called as a rights issue of a share. ESOP, employee stock option, and for the that means if employees of an organization has been working very hard for the growth of an organization, in a reward the company issued certain shares to their own employee, that can be considered as an ESOP. So, these are the various patterns that can be explained. Let us know what does the shares is all about. A unit of ownership in a company then represents a proportionate claim on the company's assets and profit. That means that a share is a unit of an ownership, a company that represents proportionate claim on a company assets and a profit. There are two different types of shares, that is common shares and preference shares. The common shares are also called as equity shares, and it represents basic ownership in a company. When I tell it is I have a running out a company, the share capital is all about that represent the capital, share represent the capital of a company. The proportionate of investment may be of 10%, 20%, 30%, 40%, 60%, and depending upon the size of capital, the size of project or the size of business, that whether it is a large scale organization, it is in a small cap, large cap, depending upon the size. We always market capitalization, we just think about this large and small cap and all, and that why the equity share represents the ownership of a company. Suppose if I have purchased one share of equity shares from Reliance, that does not mean I am a owner, I am a member, but there is a proportionate of shares that is treated as an equivalent for an ownership, that may be of depending upon their norms and rules and regulation. They decide upon what is a percentage of share that a director has to hold. And voting rights, definitely equity share or a common share owners always have a right to vote. Shareholders can vote for and corporate members, choosing of a director, choosing of a secretaries, and then what is in why we have to purchase equity share? Definitely in order to get a return. What is that return? May receive dividend which vary based on the company performance. Definitely dividends means a portion of profit which is being distributed to the shareholders. So, here in an equity share we do not give more importance for claiming of an dividend. In the continuous return we always focus on the total increase in a value of a share, that is we call it as another term called capital gain, that is potential for appreciation in value. That is, suppose right now the shares which has been issued at 100 rupees, right now the market value is 150 rupees. If I have purchased of 100 shares, right now the share what I have been bought is for 100 and now I can sell it for 150, that is increase, that is capital gain, that is increase in your capital. That is a major focus for an equity shareholders, because they will be treated as owners of a company. The second one is preference share, preference shareholder. The word itself will tell preference, the person one who give preference for the getting a continuous return in the form of dividend is called as a preference share. Typically do not have voting rights, and preference shareholders do not have voting rights, and they are got fixed dividends, okay, receive that they expect the first preference shareholders give preference to get the dividend, that is what I mentioned earlier, that is a continuous return, receives a dividend at a fixed rate before common shareholders. That means equity shareholders will be given last option for payment of dividends. Instead, they will be first preference will be given for the payment of dividend would be of a preference shareholder. Higher claim on asset in the event of liquidation. When the company is going to get liquidated, they always be giving a higher claim of an asset. So, these are the two different types of shares that will come across under shares. When we talk about shares, the cost of equity, we call it as KE, or KE represent the cost of equity. As I mentioned, whether it is a common share, equity share or a preference share, it is ultimately shares that has been measured in terms of dividends. When we think about types of share, common shares and preferred shares, these are the external source of financing, where internal source of financing, retained earnings can also be taken. Retained earnings can be treated as an internal source of financing, and this can also represent KE, cost of equity, but it is raised from a internal finance. So, these are the major concept with regard to an shares. The next one is term loan, that is debt. Okay, what does a term loan? A term loan is a monetary loan that is repaid in regular payment over a period, set period of time. These loans generally carry a fixed interest rate and defined repayment schedule. That is in the last class, that is I just in the module 2 just discussed with regard to an what is it, bond. With regard to a calculation of an interest payment, whether it is a simple interest, whether it is a compound interest, annuity, all these things, whether it is a future value and a present value. So, based on that, the term loan is all about repayment of interest, and what is the core concept has been payment of interest is a debt financing. So, here we represent KD, that is cost of debt. Okay. Term loan can be of a short term loan, medium term loan or a long term loan. That is, loan can be of short term, medium term and a long term loan. Short term loan less than 1 year, uses working capital needs, inventory purchases, immediate financial needs, liquidity, we do call it as in liquidity. Medium term loans within 1 to 5 years, uses business expansion, acquisition of equipments, modernization. These are the thing. And long term loans, duration is more than 5 years, major capital investment, real estate, infrastructure projects, these are the major projects. So, that is the project which the loan which has been used for more than 5 years, that can be treated as a capital investment. Capital investment directly hampers the capital expenditure, that is capital budgeting, in other terms we do call it as in capital budgeting. So, these are the three major concepts the important called as a term loan. Term loan, again here when we call KD, the loan, that is cost of debt has been loan. When we talk about bond or a debenture, it is an instrument which is been, bond is also a debt instrument, debenture is also a debt instrument. Bond will be issued by public sector undertakings and debentures will be issued by public limited companies, where private and public limited companies will be issuing. Both are debt instrument, bond and a debenture, but the fixed rate of fixed rate of interest rate which has been agreed by a fixed rate of interest which should be repaid to the debenture holder or a bond holder at a specific time period. Here also in a term loan, it is an obligation to pay an interest payment. When we talk about cost of equity or a cost of debt, or equity or a debt, equity is a sources of finance and debt is also sources of finance, where a combination of these two plays a major role. Because when we raise only through equity, here we think about an obligation of satisfying, because the main motto of a manager, or of a organization is to, we always state that is motto is to shareholders wealth maximization. When we think about shareholders wealth maximization, okay, then as in terms of an owner's in terms of an organization perspective, in terms of owner perspective, we always think about investment decision, where to invest this money, where to invest the profit which is being earned by a company. So, when we think about a term loans, so their equity we think about a dividends, whereas in a term loans we think about an interest. So, if we borrow more loans, that means that we have to be obligated and committed for the payment of interest. Suppose company earns profit or not, dividend will be paid. As I mentioned earlier, dividends is a portion of profit. When a company earns profit, then only the preference shareholders will always have a right to claim over dividend. When a company earns losses, so the company need not to pay profit since it has been running under a loss. Whereas here in a dividend, I am sorry, in a term loan, whether the company earns profit or loss, the company has to pay interest. There is an obligation, and this debt will always have an that does not mean that risk factor of preference is high and compared to the debt, it is the risk factor is lesser and compared to the equity, but the combination of these two helps us from a tax protection. Next one is a lease financing. What does this lease financing means? Suppose if we go with an lease financing in the sense that before lease and the agreement, we go with a rental agreement, we just always think about an obligation to pay for utilizing a space, for utilizing of those machinery. So, this is also another type of concept. Lease financing is a method of obtaining the use of asset such as equipment or property through rental agreement. It allows business to use an asset without ownership, typically in exchange for regular lease payment over a specified period. So, when we talk about the lease financing, it is also one of the method for an, but it is lease when we talk, talk about fixed asset, that is, or in terms of land or a land and building and plant and machinery. So, based on the rental agreement that they have to go. So, here we just go in detail with regard to what are the types of lease financing. One is capital lease, another one is a operating lease. What is a capital lease? A lease is treated as the owner of asset for accounting and tax purposes. Yes, capital lease, that means that is a lessee is treated as the owner of the asset. The person who leases go with a rental agreement, that is a lessee and a lessor. Lessee will be treated as an owner of the company, often used for long term lease where the lessee assumes most of the risk and benefits of ownership. That is, until we utilize that space, utilize that property, it will be on our the hold that has been ownership has been transferred to our. Whereas in an operating lease, lessee do not assume its ownership, only for that particular time period that property, that is asset, will be used, but whatever happens to that machinery, ultimately the ownership will not remain with whatever happens to that asset, the ownership cannot be claimed by me, it should be paid by the lessor. That is what lessee does not assume ownership of asset and typically returns it at the end of the lease term, that is a lease agreement, often used for short term lease with lower monthly repayment. When we call sources of finance, we just do not fall under two categories only, but only debt and equity. This is also another pattern, that is financing of your asset based on going with a rental agreement. The next one would be hybrid financing. Hybrid, the combination of different, we call it as an hybrid financing. That is, hybrid financing refers to a combination of different types of financing instrument or structures used by a business to raise capital. It involves blending element of debt and equity financing to tailoring the funding approach to the specific needs and circumstances of the business. That the combination of raising of capital in terms of debt and equity will be called as a hybrid financing. The types of hybrid financing instruments are convertible bonds, debt bonds, as I told you, the debt and equity. As I mentioned clearly, that is, it's a hybrid means debt combination on debt and equity. The bonds which are easily converted from debt into equity is called as a convertible bond, but it will be converted in a purpose of ratios. Okay, purpose of ratio. Debt securities that can be converted into equity shares at a predetermined conversion price or a ratio. Please highlight the point of predetermined price and a conversion price or a ratio, and that is called as a convertible bonds. And the second one is preferred equity. Equity instrument with priority over common equity in terms of dividends and liquidation preference, often the fixed dividend, often with fixed dividend payment. Definitely the preferential rights will be given to them to claim over a dividend. And the next one is convertible preferred stock. Convertible, as I told you, convertible bonds, the bond which debt can be easily converted into equity. Here equity can be common, that is preferred stock that can be converted into predetermined equity shares, where equity shareholders will be given importance for a capital gain rather than a dividend. So, preferred stock that can be converted into a predetermined number of common shares at a specified conversion ratio. And the next one is warrants. Warrants are the sense it is in a derivative market. When we come across in a derivative securities, the buyer will be given an obligation to buy the shares for a future date. Buyer will be given an obligation to buy the shares at a future date, and that will issue an warrant by the security market. So, derivative securities that give the holder the right to buy a specific number of shares at a predetermined price within a certain period. Yes, the share price in the right now it is for the next it is right now it is 10 rupees, or maybe it will be increased. You can buy it in we put an obligation to buy it at the future for an 11 rupees or a 9 rupees or a 8 rupees based on his predetermined price. So, based on future date, the certain period, and the security market will issue an warrants, and that can be treated as a example for. That means that a derivative securities always tend to buy an obligation for a future date, and then its acceptance and rejection depends upon the individual concept. And these are the examples for what is a hybrid financing, types of the hybrid financing. The next one, venture capital. Yeah, venture capital we just discussed in the external source of capital. As I mentioned earlier, that it's for the company which is at the initial stage where the funding is being generated for the startups. So, that would be represented as a venture capital. So, venture capital is a type of highlight the point, private equity financing provider provided to an early stage high potential startups and growth companies with the aim of generating significant returns on investment. Venture capital firms typically invest in exchange for equity ownership in the company. That is, equity ownership of a company can be treated. The ventures, different new ventures, new startups where the company, you can see the cosmetic company 82E, which has been it's a new startup where Deepika Padukone is one who has been invested. That is, she is an venture capitalist. Okay. So, initially the venture capital investment, there are different stages that has been represented. First one is seed stage in the sense initial stage, at the beginning, budding of a seeds. Initial funding provides to startup in the idea or a concept stage to help them develop a prototype of or a proof of concept. Initial funding provided to startup in the idea, that is in the basis of ideas or in the basis of that is proved. I have an idea and you have a money, my idea will be implemented and the fund will be invested. That would be represented as a seed stage, early stage and a bit ahead of it, and funding provided to startup with a viable product or services but limited revenue or market tractions. That is and once the initial stage my concept has been accepted, definitely then it will be funded to an early stage. That is, in a later stage we decide what is the asset is being required for what is the product that has been required for to develop for the business. That is an early stage. Next, expansion stage, that is after then we think about, once it has been well established, we think about an investment, that is investment provided to companies that have achieved product market fit and are scaling their operations. That is for further expansion of that has been third stage. Okay. And the later stage, the financing provides to mature companies with established products and significant revenue, often for further expansion or preparing for an exit. That is, it has been a contribution given but initially venture capital will support at all the stages, but initially at the first at the seed stage, at the early stage, and then expansion stage, that the concept has been implemented and the investment has been done, and it will be capital which has been invested and it has been a startup for a company. In early stage also will be product will be given to you and services which is then based on a market which provided. When you think about a IPL, each IPL is a core concept where each individual team has been represented with the different owners. For the sponsors will come, sponsors for their cricketing sponsors with regard to with their costumes, that is with regard their shoes, the Puma will be coming up, sponsoring will be done, and for their the sports kit whatever that has been available. So, those can also be treated to be as an capitalist where they contribute, because ultimately ends up with market fit, that is it generates a contribution that create an awareness among the market about the contribution of their company towards that particular activity what they are what they are been doing on a business. So this is what the later stage financing provides. If they want, they can continue, and exactly what happens with the film productions also. When the film has been produced, idea is different, and the story writer is different, concept writer is, I mean the art director is will be different, and but the ultimate or the director is the one, producer will be the one who will be investing on it. And then now we have been exposed to in social media marketing, where social media is also another contributor. Either you can go with the releasing of your only songs only the songs, and also the trailer release. All these are the different concept where we will come across for the strategy what they are doing to market their film in an organization. Even those concepts can also be given for an venture capital, that is where the seed money, early stage, expansion stage, later stage ultimately ends up with a raising of a fund, and as and when then it has been required by a company. The next one is angel investment and private equity. The word angel is a person, one who, when we wish whatever it has been asked, it will be given. That is what the thought we do it. But exactly the angel can be from within our family. It can be a mother, it can be a father, it can be a son, it can be a daughter, it can be a husband, anybody, or it can be a friend. Okay, angel investments refers to a process of high net worth individual angels providing financial backing to early stage startups and entrepreneurs in exchange for ownership equity in a company. That is what the world, one who gives us a major support for a growth of a company would be called as an angel investment. And what does angel investment and private equity are the two different thing. So here the private equity means, private equity refers to the investment in privately held companies by institutional investor, private equity firms or high net worth individuals. Private equity firms acquire ownership stake in companies with the aim of generating attractive returns through operational improvement and strategic initiatives and value creations. So the private angel investment and private equity are the combinations that they can generate their fund through their Hindu undivided family, or through any organization, through any institutions, or through private firms. So when we talk about the concept that is angel investments and private equity, when we talk about venture capital, when we talk about lease financing, these are all the various sources of finance that can be treated, but ultimately end up within both debt and equity. Ultimately the raising of fund end up within debt and equity. How do you treat it? That is complete. When we call upon whether it's an angel investment, whether it's an venture capitalist, whether it's when we talk about that, they're all being treated as a owner of a company. At every state of financing, we do have an exchange of ownership of equity in a company. I repeat, in every stage of activity, when we raise through any kind of investment, they always will be having an exchange of ownership of equity in a company, which is majorly focused. So when it comes to through a different sources of financing, ultimately end up with an equity and a debt. So these are the basic core concept with regard to shares, term loans, lease financing, angel investments, hybrid financing, and all concepts. Yeah, so this ends up by giving in the meaning and the concept of what does the debt and equity is all about. In the next session, we shall discuss with regard to what does it the cost of capital. The cost of capital lies between the opportunity cost. With further discussion, we will continue in the next session. Thank you.